Hello and welcome to the PINCast, the podcast presented by myself, Richard Bowser, editor and founder of Property Investor News, the monthly magazine which we launched 20 years ago back in 2002. If you want to listen to factual, no-nonsense interviews, insight and opinion from some highly experienced and respected property professionals, then this is the podcast that you really need to tune into on a regular basis. Hello, it's Richard Bowser here, the editor of Property Investor News, and welcome to our latest PINcast for our subscribers and viewers of Property Investor News. My guest today is Adam Lawrence, who needs little introduction to subscribers of Property Investor News magazine, as Adam is a regular article contributor. However, new listeners may not be familiar, so I'll leave it to Adam to tell us more about himself and what he does in property. So, hello, Adam.
Hello, Richard. Thanks for having me again.
Thank you.
So, generally speaking, have stuck to buying assets to hold them, buying under-improved, unloved, poorly asset managed, things below their full potential. I've done about 650 deals in the past just over a decade, and several hundred of those have been refurbishment. Everything from sort of flats for 20 grand, which I'm still very happy to buy, especially if they're worth 40 grand or more, all the way up to portfolios and commercial sites and some quite nice but quite involved and complicated deals.
So it's fair to say you know a little bit about property and investment, Adam.
Any of my lenders can attest to that, hopefully, I would say.
Okay, so well, listen, let's get straight to the key topic which this PINcast is about, and that is the self-proclaimed the mortgage crisis, which a week or so ago led the government to the Bank of England to make some commentary on. So, is there a mortgage crisis, Adam? Is my first commentary.
Well, we just use the word crisis every 2 or 3 months at the moment, don't we? So if we go by 2023 definitions, Richard, I suppose there is. But, I mean, the short answer realistically is no, there really isn't one. And the primary reason for that is that since the mortgage market review in 2012, and of course this isn't politically expedient, but this is just the facts really. Since the mortgage market review was implemented in 2012, which was a big review that was conducted by the regulators because of the financial crisis and the over-lending and overstretching that there was in 2005, 6, 7 that led to the bubble being burst in 08, 09 and a big problem in the market, of course, as everyone will know. They actually decided that mortgages would be stress tested at 5.5% pay rates. So everyone has been underwritten for a residential mortgage since that was implemented, so basically the last 11 years pretty much, although they did drop that requirement last year, which was kind of inexplicable, but then rates were rising then anyway, and of course anyone who fixed in the last 12 months is not caught up in this maelstrom at the moment either. It's just tested at 5.5, and ultimately most pay rates, although the 2-year has gone above 5.5, it's gone up to about 6 and it's sort of wobbling around up there. You're still looking at about 5.5. So what you're really looking at more in a much more likely way is, in reality, the vast majority of people, if they were paying 1% or 2% or 2.5%, they haven't necessarily used that extra money to pay down their mortgage. They might have done, but they haven't necessarily invested it. Some of them, I would suggest the majority of them, have consumed it. Yeah. And they've spent it on holidays, they've spent it on other things, they've spent it on lifestyle, they've expanded their lifestyles. And that's what will hurt contracting lifestyle, and that's already been happening anyway over the past 12 months because of things like the price of fuel, the price of energy, and all the rest of it. So we also got to put into context that we're in a much better position in terms of indebtedness than we were in times that are mentioned. People talk about the 80s and the 70s and the 90s without really being historically accurate about what they say most of the time. But far more people had a mortgage. Because remember that, the middle class was emerging. Yes. Their right to buy was in full swing. The data shows just 28% of households are owner-occupier with mortgage. Indeed. And that average loan to value is around about 42%.
Yeah, so there's a lot of equity out there, isn't there?
Yeah, absolutely. And the thing is that first-time buyers who bought in 2021 and used a 2-year product, right, they probably possibly overpaid for that property in what was a market that was heating up.
Yeah.
and that market has now wobbled and maybe gone a little bit sideways, although it's probably still a bit up from June 2021, to be honest with you.
Yeah.
But of course, it depends how bearish the surveyor, the valuers are feeling. But if they did overpay and they went onto a 2-year rate and they're now looking to refinance, that specific demographic is definitely in a little bit of trouble. Yeah, sure. But that's a very, very small number of households. And I don't mean to sound like an uncaring economist, but if we worry about every time 1% or 0.something% of the population are in trouble, then the government will, absolutely implode with the amount of stimulus and handouts it gives away. And it's just not a viable option, Richard, really.
No, quite. Yeah. So clearly, as you say, we are well aware of what has happened since last autumn in respect of bank rates and inflation, obviously coming out of COVID and the recovery and all of the boost to money supply from all of the government lending to businesses, etc. And then, of course, we had the Liz Truss and Kwarteng budget, and then rates all of a sudden rocketed from where they were. And that's caught a lot of people out, hasn't it? A lot of people were not expecting the type of rates. I mean, I can speak personally. I was fortunate enough to come off a 1.8% deal, and I managed to fix at 4.2, and that same product now is well over 5. So, but as you say, Adam, we're not talking about millions and millions in this situation, are we?
No, we're not. The big number that's hitting the headlines is that people are talking about, people are dropping off their fixed rates, and there's 1.3 million people dropping off over the next by the end of the year, and there's this and there's that. But again, they're not trying to sort those 1.3 million into, well, what percentage of them are likely in any sort of real trouble. Quite. And of course, now we've had the government do the politically expedient thing and allow for people to not be repossessed for up to 12 months, which is what they did during COVID.
Yes.
So there's a sort of semi-solution there on that front. But realistically, it's a belt tightening and it's a degradation in lifestyle, which voters don't like and people don't want. It's really, a lot of this, Richard, is the direction of travel, and that's what's worrying the markets. Core inflation isn't under control. Yeah. We haven't seen the peak in core inflation yet. We have seen the peak in CPI. We can say that with absolute authority, because that was back in October last year.
Yes.
But core lags a little bit, and there are a number of things that are, but the big one is always going to be the wage price spiral. That they've kept under control in a better way this time, but there's always a tilt towards Labour having the upper hand, not the capital L Labour, but the lowercase L, after a pandemic, and this pandemic has been no different because of people facing different choices for the future, people making the most of the stimulus and breaking away from the rat race, retiring earlier,
yes,
and all the rest of it. And a lot of that skill and that also that tax that they were paying is lost forever to an extent. So the concern is the direction of travel. But I honestly, I feel we are 1 or 2 months away from peak core inflation,
right? And
we will get it under control on the way down, and that will calm down the bond markets and the swap markets, which are effectively where the mortgage rates are set.
Yeah, I mean, obviously, the politicians is always responding, particularly at this moment with, as you've already mentioned, an election, 15, 18 months away, wanting to be seen to be doing something. Last week's announcement obviously was designed to try and placate people or try and reassure. But you're saying, in your opinion, that core inflation, which is led by UK factors in terms of wage expectations and wage growth, you think that's coming towards the peak quite soon?
I do, and that's based on a few different things, but ultimately, remember, core strips out particularly volatile things like food and energy, and it's mainly, services inflation is a big one, and services inflation has been up and up, is on up and up.
Yes.
But a lot of this is driven by people, by expectation, remember. So the expectation of employees that employers can afford more money. Now, they can afford more money while they're putting prices up. But as affordability starts to pinch, we've got, 40% more liquidations than we had in 2019, for example. That's on the rise, and that will put more people into the unemployment pool. Mm-hmm. That ultimately weakens the position in the labour market compared to where we have been. Vacancies are trending downwards, and they have been for 6 months. They're still 29% above where they were in 2019.
Yes,
which is a lot.
Yes, absolutely.
In 4 years, and too much, really. In the 4 years before that, they trended upwards about 15, 16%. So we're outside of incredibly beyond range now at the moment. And of course, we have to remember we've got huge net migration figures at the moment.
I was going to come on to that. Yeah, absolutely. We've got 600 odd thousand. Yeah.
Absolutely, and maybe 800,000 this year. We've been told.
Yes.
Well, that ultimately, regardless of depoliticising all of that, that pumps a lot of people into the labour market because those people are, generally speaking, of working age and seeking work and seeking to make a lot of themselves in the UK.
Yeah,
which we need, we need desperately. So, so that kind of that all these things are all coming back towards the balance. And we've all taken a bit of a haircut, but then we all got looked after so very well.
Indeed.
In the pandemic.
That's
kind of.
Yeah.
I think most people accept that to an extent, Richard, anyway, to an extent.
Okay, so turning back to rates and looking ahead, I mean, we've mentioned obviously where you feel things are at, but what are the implications for landlord investors and also for property developers? I mean, we've just published a piece in Property Investor News talking about the construction market and how many contractors are being impacted by weakness in the buying market. What are your thoughts there on the implications for these rises in bank rate and lending rates? Because obviously, clearly, it's not just buy-to-let borrowers. The people borrowing financing for development are also impacted as well.
Yeah, absolutely. So I think we need to probably bear in mind as many landlords will be on fixed deals and dropping off at the same sort of rate as homeowners.
Yes.
So we're again compartmentalising this to a relatively small segment of landlords. Although there is one notable difference that I would want to highlight, and that is those who are holding on to mortgages that are on base rate trackers since before 2008.
Indeed.
So they're now with your Topazes and your Rasincas and things like that. And of people who still hold property in their personal name, about 50% of them is the number that I think maybe the Mortgage Works or someone like that came out with, that are on these variable rates. So they are being affected, and they're on things like base rate plus 2% with a lot of their mortgages. So there's a couple of things that they can do and that they are doing proactively, really. One is a lot are facing much lower loan to values. So they have to swallow the pill, really, sell some stuff off and pay down some of the debt. If they're in particularly low yield areas, there isn't really much of a choice apart from sell the whole lot. The other choice, of course, for those who haven't necessarily used it to fund their lifestyle and have kind of kept it with a proper investment focus on it, they can reinvest some of the cash they're sitting on. Instead of buying the next property, they can pay down some of the floating rate debt. I know lots of landlords at the moment who are paying down mortgages that are on things like 8 and 9%. And then coming up with the money and saying, well, you know what, I'll remortgage in 6 months, 1 year, 2 years, whatever, where rates will be down. They might not be down as much as everybody thinks they are, but I'd expect them to be considerably better than today, maybe 1.5% lower, something in that range.
Right.
If your timing is right. And I'm talking a 2 to 3 year time horizon for that to happen. So I don't think this is an overnight thing by any stretch.
No.
I expect the yields to get worse next month when we see core at 7.3 or 7.4 in June, which is pretty much nailed on as much as these things can ever be nailed. And that's my number for core next month, which is an increase on the 7.1 for May. And then 11/12 of that is already decided because we have the month-on-month figures, if that makes sense.
Yes.
It's a case of looking at what drops off and what drops back in. So developers, I think we're probably facing at the moment a pretty sideways market, I think it would be fair to say. So I think if you appraise your developments correctly, you shouldn't really be looking at and thinking, right, how much money am I going to make because the market goes up and up? It should stack up on its own merits. And if there is, obviously you want to develop in a rising market and it isn't rising, but presuming that's what you do for a living, you've got fixed costs, you've got skills, you've got edge, you've got ability to add value, you're going to want to get stuck into it, and you're going to need to be getting things on the way in from an acquisition perspective that are going to stack up without needing a following wind behind you. But actually, I think that, what would developers be most worried about, certainly the nationals, the lack of this support for first-time buyers, because you choke the first-time buyer part of the market. We've seen this before, many times, Richard. When that drops off, it then has an effect on what we affectionately call the second steppers and all the rest of it. So, I think you've got a large number of bank of mum and dadders who are going to refinance still to try and get their kids on the ladder. You've got gigantic demand and you've got supply constraints. So it's not, I think they've almost gone beyond demand and supply impacting the market, because there's so much of a deficit these days. It really comes back down to affordability.
Indeed, yeah.
And it still comes down to people finding deposits. So,
well, that's the key thing nowadays, isn't it?
This is it. So unless that's addressed, obviously, Skipton in their own way have addressed that with this 100% mortgage product. But of course, the affordability counts are not necessarily so easy. But there are still quite a few people who fit into that bracket and can decide if they want to effectively pay the same as they're paying in rent, but own the property and do the work that comes with owning the property, of course, which we shouldn't forget. So it's kind of, it's a bit, what it feels like is it's quite treacly, it's difficult. There's always lots of frictional costs involved. It's not a crisis where everybody needs to sell up or is getting repossessed or anything like that. I think commercial property landlords and commercial businesses are much more volatile, much more at risk in situations like this. And that's why they tend to have a more hands-off and higher returns on paper, but there's much more likelihood of insolvency, whereas the resi side, the risk stays so low. It's more a case of, well, the one I was going to buy over the next year or the two I was going to buy over the next 2 years, I'm actually not going to buy anything. I'm going to be sitting on the money. I'm going to be staying liquid. I'm going to be paying down some of these inordinate prices if I don't like what I can refinance that. But of course, that ultimately lowers supply of rental property.
Yes.
Because organically some landlords get fed up, they get to retirement age, many other reasons, and they divest, and they're not necessarily replaced by new money unless that new money's coming from outside of the UK. Where if I cite, something I've been aware of in the Liverpool market for the last several months is lots and lots of overseas buyers buying buy-to-let properties nice and cheaply at good rental yields, significant amount from Hong Kong, from what my contacts on the ground tell me.
Yes.
Because they want the money in the UK. They're not using mortgages. So this is very, London market 2010 to 2015. The Bank of England or whoever else couldn't control what was going on because the money was coming from abroad and it didn't need leverage. Now, if they don't need leverage and they want money inside the UK, they're not so worried by the interest rate. So there's money being pumped in there in terms of the supply side. And of course, if houses are less affordable because the price of credit is up, which is one of the things that we're maybe saying, then more people are likely to rent as well. Yeah. But remember, if their wages are going up 8% a year, and that will tail off. Again, I think that's going to tail off relatively slowly, unless we have a pretty much a black swan recessionary style event. Then we could go forward 12 months and wages could still be going up 4 or 5% a year. Well, if house prices don't move, then houses are 4 or 5% more affordable.
Indeed.
And we're nearly back to where we were for affordability before the pandemic, even though we had such a big rise in capital value between, say June 20 and June 22, a massive 25% rise in some places, maybe even more. We've had a 5% drop off, but because of inflation, these nominal figures aren't necessarily that helpful, although it's what everybody always seems to focus on.
Well, yeah, it is the nominal figures. I mean, I'm sure when we look back to the sort of 2007, 2008 sort of data moving forward, 10, 12 years or so, and people were talking about massive house price rises. And I said, well, hang on a minute, there are many parts of the country up until about 2018 that had experienced in real terms a significant decrease, not an increase. And until about 3-4 years ago, parts of the country where house prices in real terms were down sort of 20-30% or more from 2007 through over that sort of 12-year period. Okay, so
absolutely right.
Yeah,
absolutely right.
Yeah. So, Adam, what are your thoughts on sort of? I mean, obviously, you just put together an article for the magazine on talking about London and the regions, and obviously, in terms of future investment approach, but in terms of interest rate rises, the 0.5% we've just had, and maybe 1 or 2 more that we may well have possibly in the next month or so. Do you see an impact more on London or more on the regions for this, or do you just, based on what you've said already, not?
Well, it's interesting because obviously, if people do read the article, they'll see that the underlying data is that London's doing just fine in terms of its regionalised GDP, whereas some of the regions have dropped off quite a bit.
Yes,
and I think London benefits from remote workers.
Yes,
I think as an economic centre, it doesn't necessarily help your secondary office space and some of your commercial landlords, but it does help because it can get workers who are more key. They don't have to travel down there for 5 days a week.
Quite.
All those associated costs. So, the best and the biggest businesses in the country are in London. We're very disproportionate, as you know.
Oh,
Richard.
yeah, absolutely.
I think Sweden is possibly the next comparable you could use in the Western world, because Stockholm is so important to Sweden.
Yeah.
But there aren't many countries that follow this sort of model of, Greater London area, thick end of 10 million people, Greater Birmingham, knocking maybe 1.75 million. And there's just no real comparison in the economic engines of the two cities, realistically, just in terms of the scale and the volume and the buildings and all the rest of the stuff that goes along with that. But London has been, underbought really, or oversold really, since maybe 2019, 2020, in my view.
Yes.
It could still be quite flat. But again, if we go back to what we were just talking about, real terms pricing, if you said, obviously in prime, you may be talking 2014 for the
yes, indeed, yeah.
That would be you're talking sort of 15 and maybe 16 for outs or something like that. In real terms, there's a really significant discount today on some of those prices compared, after we bear inflation in mind. And leverage is not workable really at these sort of rates. But leverage, again, as referred to, does not run the London market. There's lots where we've got to really remember the point we need to hammer home is the difference between 09 and 23, or even if we look forward to 24, is that there's just so much cash still out there. So unless there's a real effort to trim the money supply via taxation or really a faster pace of quantitative tightening, which is unlikely. I think the bank's just sort of getting on with it quite quietly and quite slowly, and that's probably quite sensible. Then I don't see why leverage probably impacts less in London than it does anywhere else in the country. Yeah. So there's a potential of a resurgence, because also some of these yields will start to converge a little bit, because I remember sort of 2016, 2017, lots of investors coming up to Birmingham because the rhetoric at the time was, well, you can buy 4 flats in Birmingham for the price of 1 in London. Yeah. Now, if you look today, you'd probably find it to be more like 2.5 flats for the price of 1 in London. Yeah. And that ratio, that argument starts to fall apart, because London is London, and it's where everybody knows, and it's where, as an international investor, you know from when you travel the world, some people have not heard of Birmingham.
Absolutely.
They think it might be in Alabama or somewhere. Well, Manchester's slightly different because of the football teams, realistically.
Yeah.
And probably if you did a survey of overseas investors, they'll tell you Manchester is the second city. And then, there are, if you compare the airports and things, there are arguments for that. But you've seen big growth, especially in the suburban areas of both Birmingham and Manchester. Probably growth that, as you correctly referred to, didn't necessarily come in the 2010s, certainly in real terms. And things have rocketed forward in a few of those. Well, you can't keep forging forward at rates over and above local wage opportunities and growth rates, right? It's not sustainable. So that's the same logic as the end of the London bubble in 2014, 15, 16.
Indeed,
so,
there's the cycle. It's interesting.
There always is. People forget 1990 to 97 in London, prices didn't really move.
Correct.
And it's possible. It's possible for that to happen in. My point is, it's possible for that to happen in any. That could happen in Oxford or Cambridge. Quite. Even though it's done so well over the last decade. Mm-hmm. I'm not saying it necessarily will, because you've got to look at the regional data. But there's many more reasons to be bullish on London, and we have to also bear in mind, if you remember all the Brexit analysis, I didn't necessarily agree with it, but the prevailing opinion was London would be all right, Jack, thank you very much, but some of the regions would suffer a lot more. So this then comes back to levelling up and these things that need to be considered that I'm sure will be higher up the Labour agenda than they are the Conservative agenda. And then, before we get political about the next election, we'll probably just park that there.
Yeah, it was interesting what you said about Hong Kong buyers in the Northwest. And I think, if I'm not mistaken, we've had incoming immigration of about 60,000 from Hong Kong in the last 12 months or in 2022. And I remember talking to someone previously about this, saying that contrary to some previous sort of, waves of immigration or buying patterns from Asian nationals only buying in London. I mean, I can remember 10 years ago all the kerfuffle being made about people buying off-plan flats along the Thames and them being left empty, etc., etc. But now we've seen, anecdotally I've heard, and you just reinforced, that a lot of these buyers are actually not buying London. They're either those that have come over are buying something in the Midlands and or the Northwest to live in, but at the same time they're buying investment property as well. So rather than piling into the London market, putting all of their investments into one location, i.e. London.
That's it. The BNO visa scheme run for a couple of years, is running until at least the end of February next year. Yeah, and I just had a sneaky look. They in Hong Kong, they're saying about 145,000 moved in the first 2 years of the scheme to the UK. So as you correctly say, that might be quite a lot. I think I read the average Hong Konger was coming over with something like net assets of around 350,000 UK pounds. Right. So that's a significant amount of money to come into the economy.
Oh yes.
And they're moving into the nice leafy suburbs, and that's definitely having an impact in Solihull, where I live. There was a time for 12 months where there was a Hong Kong notary established on the high street in Solihull. Yeah. So that probably tells you just how much business they were doing there. Yeah. But that is £50 billion we're talking about coming into the UK, and this is net assets, remember. So this is not leveraged. No. So that's not a small sum of money. That's even in the days where billions seem to be thrown around left, right, and centre. It's a big number. And it seems to be that I think people are reporting back. I certainly see a lot of the Hong Kong community that's now established itself in Solihull, and they seem to have settled in very nicely. They're obviously welcomed, and I'm sure they report back to homes of people who haven't made the move yet and say, well, come over, it's great here.
And the weather's amazing.
If they're reporting back at the moment, they'll say that, but that would definitely come under mis-selling.
Yes, indeed. Yes, rainy November, December, etc., notwithstanding. Okay, Adam. Turning back to our core topic, running through the sort of what we were talking earlier. So from what you're saying, obviously the stress testing that lenders were bound to put towards borrowers in the last 12 or so years does mean that a lot of borrowers are not really at risk. But what about the proportion of people who are on relatively high loan to value terms? I think you've identified already that people perhaps that bought at the peak of the COVID support with all of that, 400 odd billion that was sloshing around the economy, handed out to businesses, bounce back loans, etc. But are you saying that, in your opinion, that it's really only that sort of cohort that potentially have got potential problems ahead in terms of loan repayment struggling?
I think so at this time. I mean, obviously there are people who just, and the vast majority of people let their mortgages organically expire. I was a bit of an outlier. I was writing and talking an awful lot about this last year, as readers of the magazine will know. And I broke a lot of my commitments up until June 2024 and paid a lot in fees to do that, but secured the last of those sort of 3.x and low fours in terms of interest rates, which gave me a 5-year runway, which was fantastic. Now, of course, still in June 24, I go back to my normal cycle. Now, I'd expect we'll definitely be on a downwards trajectory for inflation by then, and therefore the rate. But what we've got to remember, Richard, is that I know that a lot of people are going around saying, well, base was 5% in 2008 and buy-to-let used to stack up in that decade. And it did, but yields were a bit higher for a start.
Indeed.
When capital values really took off, they did get squashed a little bit. But people are forgetting what the mortgage rate, the swap rate, if you go back and look at the bond yields in the early 2000s, there were times when the 5-year was trading around about 3%. Right? Even if base rate was, and there were times when base was 3, but base sort of fluctuated between 3 and 6. But the 5-year bond really didn't trade that as high as it is today. Now, I like to look at these things in the round, 25 years, 100 years, 200 years, because you get a really much more balanced view. And that's why the current bond yield looks very expensive. But the problem is we need this, we're a different world now. So if you think back to the old Northern Rock bank runs in 2008, there's a very stark visual of that happening. Whereas there's a chap in the States, Jim Bianco, who coined the phrase a bank walk rather than a bank run. And what he's saying is money is moving away from these institutions in order to chase returns. I mean, you wouldn't have had this in 2008. You can go and put money in Chase Bank, I'm not sure what the limits are, but get a 5% interest rate. Or you can go to Tesco and get a 5.2% loan, personal loan.
Yes.
Well, look, both of those are losing money on those products, right? Because there isn't enough margin. Now, we know when companies do that, they do it to get market share.
Yeah.
And Tesco won't lose money in the long run because not everybody will pay their loans. There'll be default rates and there'll be all the rest of it. And Chase are just paying to acquire customers. But the market is so very tight around that side of things. What you've got at the moment is building societies and banks who are sitting on a lot of funds that they're paying maybe 2 or 3% on, right? And they can get now. Are they going to go and buy 5-year government bonds? Well, they can't with all of it by any stretch of the imagination because of their Tier 1 capital requirements.
Yeah.
And we haven't built the system in the same way that the US has. But of course, they could put some into longer dated bonds because they don't need all of that money they're sitting on. But would they rather put it into gilts at 4.75 or would they rather lend it out at 5.25 or 5.5? So in the same way that the London market or even the Liverpool market or whatever doesn't have to be dictated by the amount of leverage there is on every property, then also the mortgage market rates don't need to be dictated by the 5-year bond yield and the swap rate. Because there's plenty, it's now attractive for people to go back to the banks and the building societies and put money in. Now, it's not attractive when you've got inflation at 8.7 or at 7.1 because you're losing money. But remember, that 8.7 number, that's the last 12 months. That's what's already happened. We know it's trending downwards mathematically because we know fuel's got cheaper. We know energy is over its worst current crisis before I sign off that Putin isn't going to do anything crazy, which, let's face it, we just don't know. But we've got a guaranteed drop in inflation coming up over the next year. Not as much as everybody would like.
Quite, yeah.
But when we're trending the right way, the bond yields will calm down quite a bit. But if you're today head of a building society or the head of lending, head of products for a building society, you're looking to get money out the door, there's a huge opportunity because, a lot of these people are quoting what's effectively about 7.75 for a 2-year fix. Well, because it'll be like 5.75 with a 5 or 5.25 with a 5% fee. Well, you don't need to take those big chunks out if you're only paying 2 or 3% on the vast majority of your money, and you need to get back to the old school building society model of getting the money out the door. Because you remember, although people don't necessarily understand this, but building societies started to use securitisation, and they still use securitisation. So they sell on their mortgages to willing buyers of the products that have been bundled together. Now, of course, they got a very bad name in 2008, 2009, but there's nothing wrong with securitised products if your underwriting is solid, and that's what the market has always understood. But you're talking pre-securitisation here. If you're sitting on a big cash balance and you're a builder, and that's your business model, you need to get it out the door. Yeah. Right? And the best way to compete, if you're Skipton or Leeds or whoever else might be sitting on big balances, is to be competitive on price. And the building societies know that as well as they know where they need to be in the best buy tables, and that they need to come to the forefront, because some of these, in inverted commas, smaller building societies have now got some very, very serious balance sheets, and they can put a dent in the market here, and they could do to an extent, Richard, what they want in terms of if they need to focus on green mortgages, so be it. Yeah. Whatever incentive there needs to be, and the government, frankly, has got a big part to play in all of that as well, which is kind of the camp that's being kicked down the road till nearly 2030 now at the moment. But that will come into play. ESG, despite some of its failings, which in my opinion are considerable, is not going away in terms of what people care about. It's not going away. So,
particularly the younger generation is massively important.
Yeah, it's one way. It's one way to see a bit of a. And remember, 2008, when rates were 5%, you probably would have got 4% on a 5-year fixed rate bond in a building society, or maybe 3.5% or something like that. And so there was a 1.5% margin on the saver side, which is what's returned. Whereas what you've got, if you look at Barclays or Lloyds or anybody's profits for Q1 23, you'll see all they've done is increase their margin. Now, they're not going to get away with that, Richard, because they're going to be held to account. Yeah. And if they're not careful, we'll be in windfall tax territory for them, and I can absolutely guarantee that. Yeah. So the banks know they can cut their lending margins. They might need people asking for mortgages to nearly evaporate for that to happen. We've still got the tail end of people panicking and coming off deals that can just about afford to do these fixes. But as we get into the point where, because people are saying to me all the time at the moment, how do you make deals stack up at the moment? And the answer is with a bit of creativity, but also, in honesty, Richard, with difficulty. Not as much stuff is stacking up. No, of course it's not. You either need massive discounts or massive yields or massive value-add opportunities, whereas in 2019 you could do some fairly average deals fairly easily that today look magnificent because you've had a big bump in capital growth and you're getting a big bump in rents. Yeah. Now, those deals today are not there for us to transact on, and that means in 2 months' time, 3 months' time, 6 months' time, 9 months' time, the mortgage demand is lower, ultimately.
So, sort of as we're coming towards the end, Adam, I mean, how do you see the rental market, renters being affected? Obviously, because we've had, there's a lot of evidence being and anecdotal comments in the media. Some of it for politically led reasons about landlords selling up, and clearly, build to rent isn't the silver bullet. We know that. We've reported on this in the Property Investor News. In fact, we put something out last week, another commentary about the reality behind the supply of build to rent. But without question, tenants, renters, and certainly the London market has really rapidly turned round. So, and with the immigration demand, 600,000 added to the population last year. I mean, just do you see this rental crisis? Never mind the mortgage crisis, the rental crisis continuing. And I don't think those who take note of trends would contradict me by saying that government has a lot to do with creating this rental supply crisis. So what are your thoughts going forward on tenant supply? I mean, it just seems to me an unsolvable problem, one that's just going to grow and grow.
I think we're similar in the conversation that we had around housing supply. Rental supply is not anywhere near as bad as the new build supply stock situation, but it's still bad, and it's a lot. I mean, I think there was around about, I saw a Zoopla report the other month that was suggesting there was only about half the number of units on the market than there were in 2019.
Indeed,
a 50% drop.
Yes, rental property.
That's very, very problematic. But when you consider sort of London, you have to bear in mind London sort of found its affordability ceiling in rents around about the time of the peak. Again, if we looked at rents adjusted for inflation, you wouldn't see such a rip-roaring market. I mean, London lagged during the pandemic because a lot of short-term lets came back on the market.
Indeed.
And that helped things.
Yeah.
But it has recovered very, very well in the last sort of couple of years as those short-term rentals became viable again, and is being pushed upwards. But you do have to think, 3 people on anything a little bit above the living wage in London can barely afford a 1-bedroom flat. Yeah. Affordability will always govern because, the government are not going to intervene and put money into people being able to pay rents.
No.
In fact, look at what they've done to housing benefit. They've absolutely destroyed it.
Yes.
This is one of the hidden bits of the pandemic nobody talks about, and that's because politically people don't like housing benefit because it goes to landlords. But I think this is one of the things I'm hopeful that Labour might have a significant overhaul of if and when they do get into power, because that will, of course, in itself, for the likes of us, provide new opportunities.
Indeed.
In the property sector. But I think London affordability will govern. Nationwide, there's been a big push. There's this number that's come out in the last couple of weeks. 28% of income going on rent. And it's like, well, sorry, but the affordability tests we've always done, and they've led us to manage, many thousands of successful tenancies, have been up to 33%.
Yeah, 1/3. Yeah.
So there's still a 20% to get you from 28 to 33.
Indeed.
There's still a 20% rental uplift before the rest of the affordability on a nationwide aggregate perspective is pushing at those ceilings. Of course, I would say a Bristol market is closer to a London market.
Yes.
Affordability is really, really tested.
Yeah.
And therefore rent growth might not be there. But in some of the suburban markets around and about, and the secondary towns and cities, there's still a ton of, some of these rents have gone from, say, 475 for a 3-bed house maybe 5 years ago to 800 maybe.
Yes.
So not quite double.
Yes.
But the affordability of the tenants that are coming in can afford 1,000, 1,100, 1,200. And if there is a shortage of stock, and I think that's less likely the cheaper you go to, because the only place, I think David Sunderland reported on this in the EIG report that he did for June, the North East is the only place that's showing growth in the auction market at the moment.
Yes.
And that makes a lot of sense, because if you are in London, let's say, or in the South East, you've got 2 choices at the moment. Well, I suppose 3 choices. You either pay down your debts and sit on a bit less cash, because you're happy to get some of these returns you can get by not giving them to the bank and leaving them in your own pocket, right? Or you look for the far fewer deals that there are out there, or you move to a place which has got higher yield, and that inevitably takes you up towards the northeast, because even in the Midlands, at 7.75% for a 2-year fix, buy-to-let doesn't stack up.
Quite.
So affordability will always be key, and I think it's for people who are keen on data, who listen to a lot of what you've done, some of the great data for the presentations that you deliver, Richard, and the content in the magazine. I think they need to make those affordability inquiries themselves and look at things like, what's the regional wage growth and why? If you've got a a big levelling up project going on, like you have in certain parts of the northeast,
Yes.
then who's that going to bring into the area? What are they getting paid? And what's their resultant affordability? It doesn't matter that 3 beds are still 600 quid, because for a top-end product, they might be ready, willing and able to pay £1,000. And that level of vision will guide strategy and tactics going forward.
Great commentary, Adam. Great. Okay, well, unfortunately, we're out of time, and sure we could talk for much longer than the 40 minutes that we've had so far. So there we are. Listen, Adam, thank you so much for your time today. We've touched on the mortgage crisis and maybe debunked some of the sort of media hysteria around this. Obviously, you know, as you said, I mean, there's a basis of fact. Some people are massively impacted. Yeah. Okay, so Adam, thank you very much for your time today. It's Richard Bowser, Property Investor News, for the latest PINCast. Adam, within the magazine, obviously people know how they can contact you, and also through your situation and the Partners in Property meetings, which take place each month around the UK. How many locations are there now?
So we're in 4 locations: London, Birmingham, Manchester and Bristol.
Great. Well, obviously, we'll put a link with the show notes for people to learn more about when those events are taking place and through to the website. Once again, Adam, thank you very much for your time today. And on behalf of listeners, it's Richard Bowser talking with Adam Lawrence. Thank you.
Thanks, Richard.
Thank you for listening to this latest PINCast from Property Investor News. Make sure you've subscribed to be notified when the next episode is released. Register for the PIN e-news service at www.property-investor-news.com, where you can also sign up as a magazine subscriber and get the monthly print magazine. By subscribing to the magazine, you can get access to 17,000 articles which we've published in the last 20 years, alongside some 300 webinars and video interviews.